Something is happening to the US dollar right now that hasn't happened in decades. And if you have money in a retirement account, a savings account, or even just a paycheck, you need to understand this. Central banks around the world have reduced their dollar holdings to a 30-year low. The dollar's share of global reserves just fell to 56%, the lowest since the mid-1990s. And Warren Buffett? He's holding more cash than he held during the 2008 financial crisis, the dot-com crash, and Black Monday combined. $381 billion. That's not a typo. That's the largest cash position in Berkshire Hathaway's history. And the question you need to ask is, what does he see that most people are missing? This isn't speculation. It's verified in Berkshire Hathaway's official earnings release from November 1st, 2025. $381 billion just sitting in Treasury bills, while the stock market climbs to record highs. For a man who built his entire fortune by staying invested, this is the most dramatic defensive position he's taken in 70 years. And recently, President Trump's team has made it clear through policy documents and public statements that they're willing to fundamentally restructure America's relationship with NATO allies around burden sharing and financial obligations. When you connect these two data points, a concerning picture emerges about the future of the dollar and what it means for your savings. Before we go further, let me be clear. This is educational analysis based on publicly available information, not financial advice. Trump administration officials have not explicitly stated they're targeting dollar reserve holdings, but the implications of their stated NATO policies are worth examining. I encourage you to verify everything independently and consult licensed financial professionals. And if you value this kind of detailed analysis that goes beyond the headlines, please subscribe to this channel. We're committed to breaking down complex economic situations into clear understanding. Now let me walk you through exactly what's happening and why it matters. According to Berkshire Hathaway's Q3 2025 SEC filings, the company is holding $381.67 billion in cash and Treasury bills. During the 2008 crisis when banks were collapsing, Buffett's cash peaked at $44 billion. Today, he's holding nearly 9 times that amount. This current position dwarfs every defensive stance he's ever taken. If we analyze historical patterns, cash positions of this magnitude typically precede major market dislocations. Most commentators say stocks are overvalued or point to interest rates making cash attractive. But these explanations miss the structural picture. Here's where Trump's evolving NATO policy becomes relevant. According to national security strategy documents and public statements over the past 18 months, there's clear willingness to restructure America's defense commitments to allies who don't meet burden-sharing requirements. Multiple reports from Reuters, Bloomberg, and the Financial Times have documented discussions about using America's security umbrella as leverage for broader concessions. Let me explain why this creates what currency analysts call a confidence event in dollar markets. For 80 years since Bretton Woods in 1944, the U.S. dollar has functioned as the world's primary reserve currency. When Germany buys oil from Saudi Arabia, they use dollars. When Japan holds safe reserves, they buy U.S. Treasury bonds. When any country stores wealth safely, they convert it into dollars. This creates massive, continuous demand for dollars, regardless of America's actual economic fundamentals. That structural demand has allowed the United States to run enormous fiscal deficits, print trillions of dollars, and maintain a standard of living that productivity alone wouldn't support. We've been living on what economists call exorbitant privilege. But here's the critical vulnerability Buffett appears to be pricing in. That privilege depends entirely on confidence. It's not backed by gold anymore. It's backed by the perception that the dollar is safe, that America is stable, and that the U.S. will honor its commitments. According to the International Monetary Fund's COFR data from Q2 2025, global central banks hold approximately $12.94 trillion in total foreign exchange reserves. The U.S. dollar share has fallen to 56.32%, the lowest level in at least 30 years. Just one quarter earlier, the dollar represented 57.79%. That's a 1.47 percentage point drop in 3 months. The IMF notes much of this decline is due to exchange rate effects, but even when adjusted, the dollar's share still declined. The trend is clear. Central banks worldwide are quietly diversifying away from dollar dependence. NATO countries and close allies represent an estimated $2 trillion of global dollar reserves. If policy signals suggest America's security commitments are conditional or transactional, it introduces uncertainty into what has been the most certain thing in global finance for 80 years. Think of it like a crowded theater. As long as everyone stays seated, everything functions smoothly. But the moment someone credibly suggests there might be a problem, human psychology takes over. People rush for the doors simultaneously. When everyone tries to get through the same doorway at once, people get hurt. That's the dynamic in currency markets when confidence starts to crack. It's not gradual, it's nonlinear. And this is exactly the kind of risk that someone with Buffett's 70 years of experience would position against. Trump's policy approach toward NATO centers on demanding allies increase defense spending to 2% of GDP. Supporters argue this is overdue burden sharing that corrects decades of European free-riding. That's a legitimate policy position. However, if we analyze this through the lens of currency markets and investor psychology, the method matters as much as the goal. When you signal that America's most foundational security commitment is conditional and transactional, you're teaching global investors that American commitments are unreliable. That's not a political judgment, it's a market observation. And once that lesson is learned, even if the policy reverses, the damage persists. According to game theory research, it takes one instance of defection to break trust, but many iterations to rebuild it. Let me show you what this means in concrete terms for regular Americans. When foreign countries reduce dollar reserve holdings, it puts downward pressure on the dollar's value and upward pressure on U.S. interest rates. The U.S. government currently pays approximately $970 billion per year in interest on the national debt according to Treasury's fiscal year 2025 statement. That's nearly $1 trillion just in interest payments. That's more than the United States spends on national defense. Interest is now the third largest federal expenditure behind only Social Security and Medicare. According to the American Action Forum, that $970 billion represents roughly $7,300 per household in America. For every dollar of taxes collected, 19 cents goes just to pay interest. If interest rates rise by just 2 percentage points due to reduced foreign demand for Treasury bonds, that annual interest bill could increase by $600 to $700 billion, according to Congressional Budget Office projections. That money has to come from somewhere. Where? There are only three options: higher taxes, cuts to Social Security and Medicare, or the Federal Reserve printing more money causing inflation. There is no fourth option. Let me make this personal. Imagine you're Tom Richardson, a 58-year-old electrician in Phoenix making $72,000 a year. He's got $340,000 saved in his 401k, mostly in an S&P 500 index fund. He's planning to retire at 65. By conventional wisdom, he's done everything right. But here's Tom's vulnerability. If the dollar loses 20% of its purchasing power relative to other currencies, Tom's $340,000 doesn't become $272,000 on his statement. It still shows $340,000 in nominal dollars. But the real purchasing power, especially for anything imported like cars, electronics, fuel, or medications, drops by 20%. His retirement budget just got 20% more expensive. Now multiply Tom by approximately 50 million American retirees and pre-retirees who have wealth stored in dollar-denominated assets. This represents a massive wealth transfer that happens invisibly through currency depreciation. This is why Buffett's $381 billion cash position is so significant. He's not positioning for a typical recession where earnings decline temporarily and recover. He'd be buying solid businesses at reasonable prices like every previous downturn. Instead, he's holding cash at unprecedented levels, suggesting he's positioning for a currency event or major repricing of dollar assets. When the dollar weakens significantly, imported goods become more expensive immediately. The United States imports approximately 6 to 7 million barrels of oil per day. If the dollar declines 15% against major currencies, oil effectively becomes 15% more expensive. According to AAA data, the average household spends approximately $2,800 to $3,000 per year on gasoline. A 15% increase means an extra $420 to $450 annually just to drive to work. But it extends far beyond energy. According to Commerce Department data, approximately 40% of consumer goods purchased in America are either imported directly or contain significant imported components. Electronics from Asia, clothing from Southeast Asia, pharmaceuticals from India, fresh produce from Mexico. A 15% weaker dollar makes all of it more expensive simultaneously. For a household earning $60,000 per year, if their cost of living increases by 8 to 10% due to currency-related price increases, they've taken a $4,800 to $6,000 annual reduction in real purchasing power without their employer changing anything. The paycheck says $60,000, but their lifestyle corresponds to $54,000. That's the invisible tax of currency depreciation. Buffett's not worried about a recession, which are temporary. He appears concerned about a currency event, which creates permanent losses in purchasing power. The dollar that bought a gallon of milk in 1970 can't even buy a candy bar today. What analysts worry about is similar magnitude loss compressed into a shorter time frame. Let me address the political complexity. Trump's NATO policy objectives might have completely legitimate strategic rationale. Reducing America's disproportionate military burden, forcing wealthy European countries to fund their own defense. These are goals serious people debate. However, execution method matters enormously in financial markets. When you use the dollar and America's security commitments as negotiating leverage, you're introducing uncertainty into what has been treated as certain for 3 generations. Markets price uncertainty with a discount. This creates what economists call a time inconsistency problem. Even if the immediate goal is achieved, Europe increases defense spending to 3%. The long-term cost might be that allies permanently diversify away from dollar dependence because they learned American commitments are conditional. You win the negotiation, but lose the structural advantage. Historical parallel. After World War II, Britain tried to maintain the pound sterling's role as a reserve currency while simultaneously using it as a political tool. By 1967, the pound had collapsed as a reserve currency, and Britain never recovered that financial influence. The lesson: you cannot simultaneously weaponize your currency and expect others to trust it as a store of value. If the U.S. makes a similar error with the dollar, China is positioned to benefit with the yuan. Unlike 1967 Britain, which handed dominance to an ally, America would be ceding ground to a strategic competitor. According to analysis from major financial institutions, including J.P. Morgan Chase, Deutsche Bank, and Goldman Sachs, published in 2024 and early 2025, if major allies begin systematic diversification of dollar reserves, measurable impacts could appear within 6 to 12 months. Currency markets are the most liquid in the world. According to the Bank for International Settlements 2025 survey, approximately $7.5 trillion changes hands daily. They move fast. You might think, the government will fix this if it gets bad. I need you to understand the constraints. The Federal Reserve can print dollars, but cannot force foreign countries to hold them. The Treasury can issue debt, but cannot force foreign investors to buy it at previous prices. Once confidence cracks, traditional tools become less effective. This is what Buffett appears to see: a scenario where normal escape routes are blocked. You cannot repair a crisis of confidence by providing more of the thing people have lost confidence in. So what does this mean for you practically? I cannot give specific financial advice, but I can explain what Buffett's playbook suggests. First, cash has value during liquidity crises, even if it loses some purchasing power to inflation. When everyone desperately needs liquidity, cash becomes the most valuable asset. Second, real assets that maintain value across currencies productive farmland, essential infrastructure, energy production become increasingly important. Third, debt becomes more dangerous because while inflation might reduce the real value you owe, interest rate spikes could make monthly payments impossible to service. The most important preparation is psychological. If currency volatility materializes as Buffett seems to be positioning for it with his $381 billion war chest, your 401k and IRA statements will show concerning numbers. The natural human instinct is to panic and sell everything. That's exactly the wrong response. That's the moment when Buffett deploys his cash to buy assets from desperate sellers at huge discounts. The question is whether you can afford to hold on through turbulence. For most working Americans living paycheck to paycheck with no emergency reserves, the honest answer is no. They'll be forced to sell retirement assets at the worst possible time to cover immediate expenses. This is why wealth inequality accelerates during crises. The wealthy have time and capital to wait. The struggling have to sell at the bottom to make rent. I'm explaining this not to be pessimistic about America's future, but because understanding the game is the first step to not being destroyed by it. Buffett's $381 billion cash position, the largest in Berkshire Hathaway's history, is a signal. It's the most successful investor in history telling you through his actions that he'd rather accept modest returns in Treasury bills than take risk in equities near all-time highs, while currency instability looms. That should communicate everything you need to know about how serious the structural risks are. This isn't fear-mongering. This is reading the balance sheet of the global financial system and recognizing that significant adjustments may be coming. If you found this analysis valuable, if you appreciate the effort to explain complex currency dynamics and geopolitical risks in straightforward terms, I'd appreciate a like on this video. It helps this reach people making real financial decisions based on their own research, not just passively consuming headlines. Thank you for watching. Remember to verify everything through your own research, consult with licensed professionals about your specific situation, and understand that all analysis of future events involves uncertainty. Your financial security is too important to trust anyone blindly, including me.